This is the Obscurity to Authority podcast with your host, Darren Cabral.
So listen, Bryan, thank you so much for joining me, man. I appreciate you taking the time.
Yeah, my pleasure, and I appreciate your time as well.
Awesome. So we're going to jump right in with a few questions. I want you to, first of all, tell us about your business, because you're the CEO of CMI, right? And this is quite a large organization. You guys have been growing very quickly. For those of you that have not heard of it, it's Canadian Mortgages, Inc. You guys are in doing a lot of interesting work and definitely a big name in the industry. So can you tell me a little bit about what CMI is, what you guys do, and who you are?
Sure. Well, thank you. And again, I appreciate your time and everybody's time who's listening. This may sound a little cliche, but CMI was founded now about 16 years ago as a small business in my parents' basement when I was 21 years old. And, in that sense, anybody who's thinking about starting a business or, starting an operation and thinks to themselves, oh, I can't do this, or I don't have financial backing. I've never had financial backing or private equity investors ever since we started this company. And it really has been, of course, ups and downs, but it's been organic growth since inception. So, today our company is the premier residential private lender in Canada. So what that means is, anytime someone goes to a bank or a trust company in the mortgage space and they're declined, we're the next tier. So we're sort of a tier 3 lender, you could think of us as. And we also provide niche products like bridge mortgages, short-term loans, second mortgages, even for borrowers with excellent credit. So the industry has changed since 5 or 10 or even 15 years ago, where it used to be just really people who had very little credit worthiness would go to a private lender. Today, because of the B20 banking regulations that have been taking hold for the last decade or so, we do see a much higher quality average customer than we may have 5 or 10 years back. So the industry is really transformed, and its percentage of the economy is also growing. So we've got over $500 million under administration now. We're continuing to grow, substantively. And the opposite side of our business is we work with investors. So we're also one of the top alternative, fixed income or alternative investment companies in Canada. And so the mortgages that we lend to borrowers, we're typically also facilitating those as corresponding investments to family offices, accredited investors, or to one of our mortgage investment corporations.
That's amazing. And, my business, first and foremost, obviously, is a marketing agency that's Suit Social, which you may have seen. But in my heart, I am a real estate guy. My whole family's involved in real estate investment, in the real estate world. I'm involved in the real estate world. And it's incredible. And you're right. With the changing kind of big shifts right now in how financing is happening and how banks are running approvals, there's definitely a lot of people looking for alternative solutions and more creative solutions, especially in Canada. I know in the US, there's a lot of different options banks offer that we don't hear, especially for investors. So these alternatives are becoming more and more important, I think, as things kind of get a little trickier with banks. So I'm glad you guys are doing that. But so does this act as, from the lending side, because when you guys are accessing funds, are you connecting, these people with private money from other sources, or do you guys have your own pool of money and you're connecting them directly to it?
So we're really multifaceted in that sense. So we have access to different types and pools of capital that are varied in terms of their risk tolerances and investment parameters. So one of the things that actually has set us apart on really both the investor and the lending side is a lot of firms in my space are a little bit unifunctional. So they have a particular yield that they offer to the investors. They have a very particular segment of the customer that they lend money to, and that's their business. So whether it's constrained geographically or through credit profile or mortgage type, it's sort of limited. Our philosophy had always been to be multifaceted, at least within the residential space. And so we're able to offer, investments and corresponding mortgage loans, which may have very low interest rates or very high interest rates, depending on the associated risk. And, just sort of very simple big picture, we get our business from mortgage brokers. So we're only working within the mortgage broker community in Canada. Historically, we were a brokerage ourselves that worked with borrowers directly, but we shut all that down because we didn't want to be competing with, our customer base, which is really the mortgage brokerage community, right? As a business to business operation. So we're in the mortgage broker space. We get our business from brokers. We analyze the transactions when they come in. We then, if we're comfortable with them, we price them, we adjudicate them, we, facilitate everything. And then once that's done, we do a capital allocation at the end of our process. And so that can be to, we have over $100 million now in mortgage investment corporations that we manage. And we also represent some of Canada's wealthiest, family offices, where they may have an interest in us building a private program for them, similar to a pool of funds, but their own. Wow,
you are like singing my song here. This is I love this stuff. That's incredible that you built that, and that answered a lot of my questions. Because you guys, that makes sense now. You started as a brokerage, offering the broker services as well, but along the way you went, listen, we're just going to focus on the part we do best. We're not going to compete with other brokers. We're going to support them, let them do their thing, bring us business, and we're going to focus on the money side, right?
Exactly. Yeah, and we felt that for so many reasons, including from an ethical perspective, and that's really been a driving foundational force of our business. So it's not just about, yes, of course, we're a private company. We want to generate profits. We want to generate healthy returns for our investors. But at the end of the day, we also wanted to do all that within the construct of helping borrowers. When I sort of got more into the lending side of the business, part of that was instigated because, at least at the time, too many of the private lenders around were just very aggressive. I don't know what other word to use, aggressive towards borrowers, and sort of their perception was very derogatory towards this credit space. And, I had, even as a broker, experienced some of that on my customers' behalf at the time. I'm going back now, 6-7 years. So part of the foundation mentality was to make sure that we were dealing with brokers we liked and giving them respect, and in turn respecting the customer, and while looking to generate a healthy return, also making sure that we weren't taking advantage of people. And so part of that is, like, we want to make sure the premise is right for the loan right from the beginning. So if we see we're not helping someone, we're not going to do that loan, because I know both from a risk level that's going to end up in a default, and from an ethical perspective, we're not doing the right thing for that borrower. So that and how we operate our business is sort of been a driving factor, has been sort of that ethical approach. And, just as an interesting fact on that, we've done a little over about $1.2 billion in private mortgages now, just as a lender. This has nothing to do with our brokerage history prior. And I think we're still a shade under about $1 million in losses on that entire portfolio since inception. So that's, incredibly low. And it also accounts for what most would deem very high risk loans. And so it's not that we're just only doing safe bets, but part of that is, we pick the right people to lend money to, I think. And while we can be cautious compared to some of our competitors, that's contributed to a strong portfolio, which has weathered ups and downs across the country, and we think is going to be sort of a key to our long-term success.
That's incredible. So I want to do a few things here, because you're going to be a wealth of knowledge. So first, I kind of want to back up into the actual entrepreneurial side for a second and go back to the beginning when you were in your parents' basement and kind of starting this company. I'm going to go back there for a second, and then we're going to jump ahead to actual some investing stuff and some strategy and some questions that I have as well personally that I think our audience will have. But let's go back to the entrepreneurial side first. So you were in your parents' basement starting this company. This was a ways back, over a decade ago. What got you to that point? What made you think you wanted to start a business? Why was that even a decision or choice? How did you get to that?
So a little bit on a personal level, I would say I've kind of been wired that way ever since I was a teenager. So I actually, this is not even my first business. I started my first company, I think I was probably about 15 at the time. And another cliche, I was doing websites and web hosting and all these things that, all these types of sort of work that teenagers like to do at the time. And I was a computer guy. So my first business was actually like a web business. And actually had received some recognition back at the time from Royal Bank of Canada. They had like a youth entrepreneurship program. So I started out at a young age already in that direction. That business that I had started actually grew on its own into a modest-sized company when I was sort of in my late teens, early 20s. We were, I think I had around 30 people who worked for me, including some onshore and some offshore. We had branched into technology work. We were doing software, so not just websites, but e-commerce and even some sort of back office type of applications for businesses. So that first business was moderately successful. We did end up selling that company. I don't remember honestly the exact year, it's been so long, but sort of in and around the similar timing as we started looking at founding the mortgage company. So I was coming out of that business. I had a tech background, a little bit like yourself. I actually had a strong marketing background as well, with a particular emphasis to online marketing. So what actually sort of started that initial idea was I looked at the landscape and saw, in Canada, at least, there was very few mortgage brokerages who were in the online space, who had caliber websites and were focused on that online mortgage experience. Today, it's very common, but at the time it wasn't. So based on my background, I saw an opportunity to enter into that space. And incidentally, I had known a few people who were doing mortgages already, and it seemed like an interesting field. And it was, at the time, it was sort of a heyday in the mortgage industry. So it was, financially profitable. And we just sort of saw that window that, made sense to step into. So that was the original foundation of the business at the time.
Interesting. And did you know you really wanted to get into the kind of lending side of this right from the get-go? Or was there ever a moment where you were just like, this is just going to be a straight brokerage, we're going to build it out this way? Like, how did that evolve?
So that was very organic. So, when we started the business, when I started the company at the time, it really wasn't, this current iteration of it was not in that vision. It was very much hey, let's build an online mortgage company. I started hiring at the time, some friends who worked, who ended up working for me. And it was, I was building a mortgage company. I was sort of expanding that business and helping customers. But I did start off almost from the get-go, really working on the alternative mortgage segment right from day one. So we were already sort of doing private mortgages, and at the time it was called subprime, the alternative space. So that's how I did get my start. And a lot of the consumer work we did at the time was based on that. So as the years went by, and that business eventually sort of grew and then sort of began to shrink around the financial crisis, 2008, 2010. And, so I started thinking about new opportunities and where I saw the future of the industry. And at that point, I'd already been in the industry for a number of years, so I had a better understanding of all this. And, foresight, luck, mix of both, maybe you could say, identified that private lending was sort of the future of what I felt was the brokerage and the mortgage industry in the alternative space. So we then, at that time, I started doing both. So there was a period that I was doing both consumer side, and I was also doing investor and lending representation. And then as that business started to take over as the primary driver, I slowly shut down what was the original company, which today doesn't really exist except perhaps in name, and really focus all of my efforts and built a whole new staff base, technology base, products, everything, and just really focused on the private lending side to the point that we shut down the consumer business. I think we're going on about 4 years ago now entirely, and it had been already a very small part of our ecosystem for a couple of years before that.
Wow, that's incredible. And so you mentioned now you guys are somewhere around 100 staff. So obviously growing very, very quickly. What were some of the kids? Obviously, there's multiple components to what makes a successful company. You have the marketing side, the sales side, but you also have the less sexy side, which is the operations, the people, the HR, the legal, the finances, all these other systems. I mean, what were some of the components you focused on from the get-go that you needed to get right that supported that level of scale that quickly?
Technology was a big one. and that sort of came from my prior background, having been involved in a tech company already. I did have that mentality. I grew up around computers and technology, to begin with. So even though I got into the mortgage space, really almost since day one, I thought of myself as a fintech operator. And so, I had built and designed proprietary, processing software, even for the original iteration of the company, to be more efficient and to help have higher margins. And then that same, type of approach was done as well with our lending company. So we have a whole proprietary platform that we use to back our program. We today have a CTO, we have, multiple developers, we have business analysts, we have product managers. So, to some extent, we've got a full form tech company within our business. So technology has really been a core part of our success for sure. And the other piece that I credit to our success has been sort of a level of procedurization and standardization of our activities. So I was very fortunate a number of years ago to meet a lady who is today our executive vice president of our business, Elizabeth Wood. She's a fantastic operator. We really complement each other very nicely. So a lot of those items you mentioned around, operations and accounting and legal, as the business continued to grow, she, stepped into managing those areas. And in combination with that and the technology aspect that, I brought to the table and taught her, we were really able to sort of help marry process, technology into the foundation of what's become our platform.
That's incredible, because that's an important note for people that are listening. When you're in a business, especially when you're starting alone, it's sometimes as founders or owners, we tend to fall more on the visionary side, or we have these ideas, we have these great visions, we know how to move things, but we might lack some support on the implementation side of someone that's actually boots on the ground and connecting that in a way that makes sense. So you found that person that was also able to support in that and maybe was strong in that and complimented you and your technology set and your vision and all of this. How important do you think that is for a business owner to find? And when is the right time for that? When does that kind of person come into a business?
So I think as an entrepreneur, to be candid, you really have to be multifaceted. So, as much as I today tilt more towards the strategic and the vision, and that's, certainly been a driving force of the business. I also was very strong operationally. Not as strong as obviously maybe Elizabeth is today, but that was one of my strengths at the time. So I think you have to be careful as an entrepreneur. And I run into people like this a lot. They're only a visionary, and they'll talk to you about their dreams for days and years and all the plans they have, but they have absolutely no idea how to take that and actually put that into an actionable plan. So that has been part of my strength as well, being able to take that vision, break it down into actionable pieces, and then even on a personal level, be able to facilitate a lot of those individual core elements. So it is having enough marketing background that you can, run the marketing until you're big enough that you can then hire a marketing company or hire a consultant. It is, in my case, was having built the mortgage background, because I was an agent for many years. Even as an agent, I did over 1,000 mortgages at the time. So I learned mortgages. I wasn't just a business person, but at the same time, what I had, I think that the industry lacked a little bit. The industry, had a lot of people who came only from mortgage channel. So they had a lot of mortgage experience, but they didn't have the entrepreneurial side, or they didn't have the business side as much. So I was able to sort of blend what I learned, and I learned along the way. Nobody taught me, I didn't have the benefit of working at another mortgage company. And a lot of people may not realize this, but I never worked for another mortgage firm. I didn't work at a bank. I didn't work at a different mortgage brokerage. My experience as a mortgage company, a mortgage person, has been all through my own business, learning along the way, making mistakes like other people, learning from those mistakes. But I built that industry experience, and then I had already sort of the strategic vision, and I was able to marry operationally those two together. And so being able to do that at the beginning, because you don't usually have the budget to hire all these people, is critical, I think, to being successful as a business. But you've also got to recognize, once you have some kind of an ongoing, consistent, revenue stream or business flow, a lot of people then stagnate there because they're afraid of growth and they're afraid to take risk. And there is no reward in investing or life without risk. So, and I still remember some earlier conversations that I had with people surrounding me at the time. And, when I wanted to hire my first assistant, and people were like, oh, you're doing okay for yourself. Do you really want to take that risk on? And the joke, sort of, this is the internal company joke, but my dream was I didn't want to work that hard at the time. So I thought, well, I'll hire some staff and make a little bit less money, and I'll, be able to enjoy the best of both worlds. And I'm still trying to hire that one next person so I can work less. Haven't gotten there yet, maybe when it's at 200 or 150, but we got to be willing to take a little bit of that risk and sacrifice some of today's immediate benefit. And if you invest that intelligently, whether it's in technology or in vendors or into staffing to give you that missing human resource power, there's some leap where, and it's always uncomfortable, where you're kind of doing okay personally. You're going to put yourself a little bit uncomfortable, into an uncomfortable position if you do take that next step. But if you don't take that next step, you never will go past where you're at.
Yeah, 100%. I think that's what's difficult for a lot of entrepreneurs is the timing of all of that. When is it right? When is it the wrong decision? And maybe it is a little too risky at that point. And when is it risky but the right decision? I'm trying to figure out that balance. Because I mean, even for me, like when we hired our first staff, like we grew up to about 10 people. So still, well behind, still very early in our stages here. But we've grown up to like almost 10 full-time staff, and it's like, now I'm doing what you're saying is I have to wear all those hats. Like I'm the marketer, but I'm also the accounting guy that meets the accountants, and I have to deal with operations, and I have to deal with training, and I have to still deal with client fires when things blow up. And it's like I'm wearing all these hats, and we keep hiring team members for operational roles. But then I start to wonder, like, at what point do I need help? Like, at what point do I need, that executive VP or a COO or an operations manager? Because I can only do both so well. I can only manage a whole team and clients and operate and then keep moving the business forward. And I find that a lot of businesses have that struggle because you get stuck back and forth where you either are operating and you get sucked into that and you forget that the business has to move forward. You have to take calculated risks and investments and growth and vision. You forget that. Or you go to that side and you forget your people and your operations and people get upset and things start to break. Have you experienced that as well?
Yeah. Oh, yeah. Yeah. I mean, I still do. I still kind of live that life as large as we are, versus where we started. That's still my life. So, during the day, I'm typically doing operational related activities. I'm still very hands-on in our credit management processes. So, I'm looking at risk. I'm looking at operational transactions. I'm looking at sort of executive level operational work that is time sensitive. And then when all that kind of settles down at 6 o'clock, then I put on my CEO hat and I'm like, okay, great. Now let's go into, my business planning. Let's look at my pro formas. Let's do all these other things. So I'm still juggling that. And, that's, I think that's a little bit of what is successful about CMI. I am, I'm very much a lead from out front type of leader. So, I like to joke with my team, if CMI was the army, I'd be the general at the front of the line instead of at the back of the line. That's just my style. And a lot of staff have told me in that sense, I'm inspirational because like I work more hours than anyone else. I'm more responsive than almost anyone else at the business. So it kind of drives people to understand, like, as much as people may from the outside see that, oh, we're large firm or we're successful. Like, to my mind, we're still a startup and we're still a growth company. And we have like so much more to do. So, someone has to be driving that energy within the business and, trying to determine when you bring in that ops person, it sort of becomes that, if you look at your day and you see, okay, like I've got 30% of my pie and that could fill a full-time person's job. And then that time allocation, I could reallocate and generate more value for my business or shareholders if you have them, or my customers. That's when it's actually easier. It starts to become easier when you're already a going concern, right? Because then you're like, oh, I'll hire that person for $60,000 a year. That saves me a third of my day. I can then do these activities that might generate $500,000 a year in additional revenue. So that becomes a very easy investment decision. It's harder when it's person number one, person number two, right? That's what at least my experience was.
Yeah, I agree. And it's something, it's funny. This is very timely because I feel like I'm moving into that stage slowly. Because of course, also like we're a service company and service is so hands-on. There's so much operation that has to happen. And I think I'm getting to that point where it makes sense to have that support as well. But it's definitely a a balance that you seem to navigate very, very well. And I love that you lead from the front. I think that's amazing because it does set the tone. I mean, no one's ever going to be as inspired and as driven and as energetic as you are about your own brand, right? And so keeping that in the forefront is amazing. And ultimately, I always tell entrepreneurs as well as they grow in their business, like, you know, when they have that debate of, am I still working too hard? You know, when can I step back? I mean, sometimes my question to them is, and then do what? Like some of them are trying to build themselves out of their business. What are you going to do after?
Yeah.
Right?
And I mean, I'm fortunate, like I'm still a pretty young guy, right? So like, what would I do exactly? Like I would then find some other business to start or think about, because after 6 weeks I get bored, right? So it's a nice pipe dream to be like, oh, I'm going to retire or something, but like, you're not going to really retire. And you know, it's not going to, at least in my age bracket, like that's just not the outcome. So, the one thing I did see, and I actually see all the time though, and I think maybe could be a word of caution for some of the business owners and entrepreneurs out there. You know, one of my success points, as simple as it sounds, was ensuring both that I, on a personal and corporate level, lived below my means, you know, for a long time. And, you know, I see even borrowing, you know, mortgage applications from business owners. They want to invest in their business. And of course we lend for those purposes. But sometimes I see this person and, you know, they live in a $2.5 million house and they have 3 Mercedes between them and their wife. And, you know, they've got debts and, you know, like their business is doing okay. I mean, it's not making millions of dollars a year. And I think to myself, you know, maybe if you lived in $1 million house and drove some Hondas, no offense to Honda, that you'd have that surplus cash flow that you could invest into your business, and your ROI on your business is going to be way better 9 out of 10 times if it's a successful operation, even than what you're making in your real estate equity. And now real estate equity has been a great investment for 10 years, let's face it. So, I mean, people who've owned homes have done very well, and that's part of what's driven that mentality. But like when I started out, I rented. You know, I could have bought a house long before I bought my first house. I could have bought a more expensive house before I bought that house, and so on and so forth. So I always tried to put myself in a position where, because there are ups and downs, you have bad months, you have bad quarters, there are recessions. If you build your business to only succeed with a low margin in the best of times, you're all but guaranteed to lose when times change. If you build your business to be resilient and flexible on a cost basis and have surplus cash flow or personal assets to support it, you know, when that time comes, it's not even an if, it's when that time comes, whether it's situational or macro, you're positioned to weather that storm. And even now, that is still a big factor in how we run and grow our business. So, I mean, you know, we probably, as big as we are and as fast as we grow, we could be even bigger, we could be even larger if we wanted to take on, you know, debt, and if we wanted to take on equity. We haven't really done those things, and you know, we've been able to grow organically, which is wonderful for us. But that's a word of caution to people. I do see that all the time where, you know, they want to sort of live as if they've achieved the success, but they're hindering their own chance of success at the same time.
Yeah, it's so true. And I think a lot of people go through that. I know I went through it, and I actually have a philosophy of why this happens. Because I did the same thing. Like in the first couple years of my business, I think year 2 or year 3, I started making some money, and I went out and I bought the new Mercedes and the AMG and all these things. And, you know, if you look at me now, it's years later, we've grown significantly, and I'm driving, you know, a pickup truck because I love trucks. And the outward appearance of what I have has changed. But I started to think about why. Why do entrepreneurs do that? Where so early on, they got to overspend, the bigger house, the fancier cars, all these things. And I think I get it now. And I'm going to share my philosophy with you and all the listeners, which is a lot of entrepreneurs early on in their career have to go through a lot of doubt, not just from themselves, but from everybody around them. Some people might joke, they might laugh, they might kind of snicker at certain ideas or tell them that it's kind of dumb or why are they wasting their time. And I think the first moment they get a chance to prove that, and usually that's something physical or luxury, they do that. They get that car, they get their house, and it's like, look, I told you I could do it. And at least that's, I think, what my mentality was. But then you start to realize, wait a second, like nothing you ever do, first of all, will ever make them think differently. Like whoever has an opinion or who wasn't support, because the real people will support you. It's everyone else that is never going to support no matter what. They're never going to change her. But you can buy the biggest house in the block and they'll make up a story about it of why it was dumb. You can buy the nicest car. They'll say, you know, you're that asshole with that stupid car. So why bother even trying to prove that point to them? And you start to learn that. And then I go, no, now I do what's best for me, what's best for my family. And that's where I start to, downgrade a lot of that external. And I start to really upgrade the internal fortress, the stability, the cash flow, the reserves, the things that are better for us that no one else has to see.
And not everybody else sees, but it's bringing quality to your business, right? And I think that's a great analysis. And I would agree with a lot of that. I think there is this sort of desire to prove to people that you're on the right path. And it's, in some people, they're trying to convince themselves or others, or a mix of the two. I think there's also a little bit of, and I don't want to say I've suffered from this, but I've probably suffered from this. Like, there's a little bit of, you're working 15 hours a day, 6-7, days a week, and you're starting to make some money. There's the other side of the coin, which says, like, life is to enjoy. And so what is the purpose of having that money if it's not to spend some of it enjoying? So everyone has their own thing. When I was younger, proportionately speaking, I overspent on travel, right? And that was like a personal, like, I enjoyed it. And I kind of designed my business, especially at the time, I could work while traveling. So, I went to Italy for 6 weeks with my wife, for example. And, on the one hand, she's chiding me because I'm working from my phone, while we're in Venice or whatever it is. On the other hand, I got to spend 6 weeks in Italy and work from my phone and, had a great life experience. And so, I chose at the time to spend my money in those, and I would come back inspired. I would see what I was working for. And, I would come back and be, especially if I was on a, entrepreneurs burnout. Let's face it, even still, I go through burnout cycles. That's, anyone who thinks that that's not the case, you're not working hard enough as an entrepreneur, right? So that was, like, for me, at least, personally motivating and inspiring. And so my advice was, I spent too much money on travel, not problematically, but maybe proportionately at the time. And I don't regret it because, I had all these amazing memories that I can look back on trips I've taken. And, I worked through some of them, but I got to do all these amazing things that some people will never in their whole life do. So I think that there's definitely that little bit of that internal focus of, there's no point to, like, you can't take it to the grave either. So it really is a balance. You want to make sure that you are enjoying some of the fruits of your labor along the way and not just waiting only for 20 years of delayed gratification. But people often go too far the other side, and they want to, externally or internally portray themselves as if they've made it to that business 20 years ahead, but they're only 5 years into that journey.
Right. Yeah. And you said it perfectly. And I think that, kind of just looking back on it, I think, the key is, it's not that it's bad to spend money or indulge. It's like, at least make sure it's for the right reasons and it's impactful to you. Like, and I learned that because I'm the same. Like, we love travel. Like, when I go with my wife and we go somewhere, that's something that I remember, and it does energize me. And I come back with that, and I love that. And it means something to us. Whereas, like, the car, I realized really quickly, wait, like, it wasn't actually making me happy. I just kind of wanted to show everyone that I could have it, or the bigger house. I just want everyone to see it, but, like, it didn't make me happy, right? But the travel did. And I think finding things, and even for me, it's become hobbies. Like, the things I'll spend money now are things that people don't see. Like, I'm big into hunting, I'm big into shooting, I'm big into archery. I'll spend 30 grand in a year on guns or archery or something as a hobby because I enjoy it. No one sees it, no one knows, but I feel really good having it and doing it. And that's like you said, it's an overindulgence. Should I do it? Probably not. Are there better things to spend on? Probably. But it gives me a good feeling that I can enjoy and indulge personally. I think that's important as an entrepreneur because you do have to see something from your labor. Just make sure you're doing the thing for you and not for everyone watching you.
Exactly. Right? Exactly. That's the key. And whatever it is to you or that person doesn't matter, but it's a personal thing, right? So maybe it's going on a 2-month sabbatical every 12 months, and not earning the business income during that period. And that's your expense. Or maybe it's, like you said, hunting, or people like to drive, sports cars or whatever. Like, if you're really into racing cars, okay, maybe that is, somewhere to put your money. But I agree with your original point, like, just to buy a car for the sake of showing other people, oh, I'm successful, like, that's a waste of money, let's face it, right? And to buy a house that you can't afford and then struggle to pay the bills, and then if you have a down month, worry about who you're laying off, that's just downright foolish, right?
100%. And that's my philosophy. I think, and this is a good bridge, but I think some form of challenging economic times, whatever that may mean, is coming. I don't know if it's this year, 5 years, 10 years, 3 years, but I definitely think we're going to be going through a challenge I'd love to talk to you about. And I think my strategy through that has been strengthening that foundation, building up cash reserves, building up, safe investments, or putting the money in places that I know money is guaranteed or close to guaranteed, and preparing for that for one of two reasons. One, to not lose the gains that we have. Two, to not get stuck, like you said, in a bad cash flow situation where if we have a bad quarter or year, you have to decide to lay off staff if you want to keep living in your house.
Yeah.
But three, to also position for any opportunities that come up. Because as you know, there's always opportunities in those markets. There's always, whether you're a real estate investor and you're going to do a big deal because the market's plummeting and you're like, this is the time, or it's a business, you're going to buy a business, or your biggest competitor is going bankrupt and you buy all their staff or technology. Something's going to come up. Right. So are you seeing that? Are you preparing for that? Is that a thought right now in your business model?
I think it's a thought that needs to always be on every business owner's mind, because ultimately, and you said it best, something is coming, but is it in 3 months, 30 days, 30 years? No one knows. And if people ask me this all the time, oh, you're in real estate, you're in the market, you must know what's happening. And I kind of laugh. I'm like, here's what I can tell you. I've done over 5 billion, maybe more, in mortgage adjudications and analysis of credit and applications and appraisals and all of this. And I have absolutely no better idea than anyone else what's coming. What I do know is that if you're prepared for the downturn or downside when it comes, like you said, you'll be better positioned for every reason. You'll have the staying power. You'll have the ability to take advantage of, underperforming assets if that's your business. You have the ability to gain market share by dialing in to your business while others may be retrenching. So, and ultimately, like I said before, the staying power, I mean, that's key, right? Because you build and build and build and build, and there's always periods of risk that a business takes on. I mean, I look at it, the way I see my business, it's a cycle. So, we cycle between growth mode and stability mode. When you're in growth mode, you're always taking on risk. So you want to make sure you don't take on so much growth that you're betting the house, but you got to bet enough of the house to make a difference, right? So maybe bet half the house, okay? And then once you're done that growth, you can't be in growth mode forever either, because that leads to an unstable business, and it positions you where you do stretch yourself, and if it turns at the wrong time, you're in trouble. So, what we like to sort of cycle, and we kind of grow fast and hard, and then stop and stabilize, build the cash reserves again to be proportionate, because what works as a cash reserve when you're 10 people is not enough when you're 30, and what works when you're 30 isn't enough when you're 50 or 100. So it's always relative, right? So as you complete that growth cycle, you then have to go through a stability cycle, ensure that you're rebuilding that foundation or shoring up that foundation for bad times, and then make a calculated decision as to that environment. Does it make sense to grow again? Do you hit, stability point? Are there opportunities to grow? So it is sort of a little bit of that game of, on, off, I think, rather than just full tilt all the time.
Yeah, no, that's amazing advice. And I totally would agree with that. And I'll use some of that. I mean, I love talking to guests like yourself because it's stuff that I try to apply in my business as well. So I know if it's helpful for me, it's helpful to everyone listening. And I've always said my next business will be more heavily in real estate. It's definitely an area that I love. And I've kind of been dabbling from the outside, but as I build that company, this is going to be a lot of the advice that I take as I apply that. I hope our listeners will as well. So that said, you mentioned you work with a lot of investors. Is that correct?
Yeah, that's right. Yeah.
Right. So, I mean, what do you see now in the market? Because if you're dealing with a lot of investors, you're seeing kind of lending patterns and where money is flowing. Where are you seeing in terms of, let's kind of start maybe by category, where the opportunities are? Is it in multifamily? Is it in commercial? Are we seeing more industrial warehousing stuff coming up? Where are you seeing money flowing right now in the market?
So, I mean, I think it's no secret, real estate as a whole has benefited throughout the pandemic. Residential more so than commercial, I think, naturally, because while there are segments within commercial, and I full disclaimer, I'm not a commercial expert and don't pretend to be. So this is my layman's view, I guess you could say. But we've all seen things like warehousing and industrial and logistics capacity, outperform because there's a just massive demand for that as the economy is restructuring and the supply chains are changing. And, other segments like retail, standalone light commercial and things like that have certainly underperformed. commercial experts, of course, may come in and say that's exactly the right time you want to buy those underperforming assets, right? But just in terms of allocation, we've obviously seen a lot of the economic allocation moving into the residential space over the last couple of years. And broadly, alternative investments as a whole, which really encompasses all real estate, including what we do on the lending side, but also private equity, commercial, residential. I mean, all of it. Alternative investments is definitely on a 5-10 year trend, the up and coming segment relative to stocks and bonds. That's kind of been my, again, layman view. We've seen more money shifting into this side from big money and smart money, and also sort of mid-tier and smaller investors. And part of the investment side of our business, I think what people like about it is it does tend to have a lower correlation to the public markets. And within the real estate segment, mortgage investing, we kind of view as a defensive investment. So you're not going to get a 50% return on investment by owning a mortgage investment for a year. That's just not how that product works. But if there's a downturn of 10 or 15%, depending on the debt to equity that the loan is on that specific property, there is some buffer built in. So within the real estate, pyramid, equities at the top. So the people who own the property, they're going to lose their equity first before mortgage lenders take a hit. Doesn't mean mortgages are invincible, but it doesn't mean there's a buffer there. So you're trading some of that risk reward off. You're not going to get that home go from $1 million to $1.5 million in 2-3 years and make that $500,000. But if the market goes down, you're not necessarily going to lose your whole investment either. And then within mortgages, there's an ability, which is kind of what we like to do. Again, you can adjust your risk. So I have investors at both ends of the spectrum. We deal with people who are, very, very much looking for as close as they can get to a cash equivalent or cash alternative, and take on as little risk as possible while still maintaining an above inflation return. And so those investors tend to buy conservative investment funds or, conservative mortgages with lots and lots of equity to protect themselves in a downturn. And then we have investors on the other end of the spectrum who, see it as an inflationary environment. Real estate is a great inflation hedge. They see, high prints of GDP, they anticipate that to continue. And as a result, they're looking for growth and double-digit returns on their investment. So in that sense, we're sort of a facilitator. Rather than saying, oh, this is what we offer, we offer the spectrum, and we try and, based on knowing our client or KYC, we try and then position them into the most appropriate product that we offer.
Very interesting. That opens up so many questions I want to ask. I'm trying to narrow it down. So firstly, are you open on the investment side? Like, is there opportunities for investors? If someone's listening right now and they want to get involved in the investment side, providing you guys those funds to lend out, is there any sort of facility you have for that you can accommodate, or is it more just like a large family office or institution thing that you're looking for?
No, we cater to a broad spectrum. So we sort of, broadly speaking, have two programs. One is our mortgage investment corporations. These are pools of underlying mortgages, and then investors buy preferred shares in those vehicles. So, our funds, unlike some of the others in the country, are open. We are continuing to raise money there. Last year, off the cuff, I think we had a 50% growth in our assets under administration there. So those funds are growing rapidly, and they cater to a broader segment. So certainly we have, even large, I think we have a large hedge fund in there. We have large accredited investors in there, but there's also an opportunity for some smaller investors within reason and subject to, securities laws and regulations. There is an opportunity for investors who may not have tens of millions of dollars to still buy, some investments within those types of funds. And then our other program is a private placement program where we sort of curate a portfolio of mortgages for individual investors. And that's going to be, less accessible to the general public, but not necessarily family office only. So we start around about $1 million of liquid funds that someone should be able to commit to the space. So that's sort of like private wealth, minimum bar, $5 million net worth type of investor, and then go up. So not everyone who's an investor with us is a billionaire or has, hundreds of millions of dollars. And people within our mix can invest as little as, I think, $5,000 is the minimum investment.
That's amazing, actually. That's. I'm glad I asked that, because that opens up a whole other opportunity. That's definitely more the space that I'm operating in, and a lot of the people I know are operating in. So that's very interesting, because I had no idea that was even available. And obviously this ranges, but like for that kind of investor, like that private curated pool, what sort of returns? Obviously you don't guarantee returns or state, but like, are we talking about just matching inflation, those kinds of things? Are we talking about 30% crazy returns? What does that normally look like for an investor?
So, our general returns are sort of in a 6 to 12% band, let's say. So we have some individual investments which will pay maybe 13, 14, 15, but that's sort of a thinner part of the market, and some which may be as low as 5% for very, very safe. But our typical band is sort of 6 to 12, that you're going to fall in depending on the risk that's being picked up. And we have 3 mortgage investment corporations, and they're a little bit similar. So we have one that pays around 6, 6.5. We have one that pays around 8, 8.5. We have one that pays around 10 to 11. So even within those vehicles, there's an opportunity for people to self-select their comfort level as it relates to their investment experience and risk tolerances. And so, on the private placement side, the advantage is people are really able to curate. I only want BC, I'm only comfortable with BC, or I only want Ontario, or I only want Alberta, or something like that. Or they could say to us, we're comfortable in major metros in most areas. So that's a very flexible program, but works if you have enough to buy. Like, we're not going to take someone's, 300 grand, put into one investment, because it doesn't matter what we do, that investment can, or, may or may not perform. May or may not have, someone who bounces a check if they lose a job. I mean, that's the nature of the investment. So even there, we like to create some diversification. We think it's smart risk management. And then for people who don't have enough to do that on their own, or just want a totally passive experience, they can buy preferred shares in the funds. And then we manage it's still the same asset, ultimately investing into these residential mortgages, but they don't have to worry about if one customer doesn't pay that month. There's still maybe another 150 customers in that pool that are paying, and you don't really notice that on their monthly distribution.
Right. That's a great point. I have one more question for you before I let you go, because I know we're short on time. But my last question to you, because we are Canadian, you guys are Canadian based, and there's definitely interesting things going on in the kind of political spectrum as well. When it comes to multifamily real estate, is there ever a consideration or fear or even just conversation around kind of evolving compliance or government intervention? Like, is there any thought or fear of, rent control, right, cracking down, or social housing kind of taking over a government? Is there any element of that in the risk management, or is that something we're thinking about, or really shouldn't be a concern right now?
My view on that broadly is that, and sort of the data I think would support this, Canada has underbuilt housing for years, decades. I believe recent studies have shown that within the G7, Canada is, despite what most Canadians would think, it's actually one of the most underhoused countries, meaning that there's a lower number of housing units relative to population in the country. And, we've, of course, ratcheted up immigration targets concurrently at the same time. So immigration, there's no doubt, as a big economic driver for Canada and population growth, which in turn generates need for housing. And to some extent, whether they're owners or renters, people still need to live somewhere. So from my end, at least, I'm supportive of government programs which are looking to trying to get more affordable housing into the marketplace. I don't personally think that it's going to do much. The amount of money they're talking about is really small, and the number of units, thousands here, hundreds there, even 10,000. It's really not very substantive in terms of the overall amount of housing stock that Canada has. So I think that, while those are nice to have, do I think that that's going to materially change the market? No, I don't. And I think that ultimately, over time, there's an opportunity for more purpose-built rental housing. And I do think that governments as a whole are starting to wake up to that. And while I don't think that, you want to move to, from, let's say, the Canadian tightly controlled zoning approach to a Texas-style no zoning market, but I do think that there ultimately has to be a little bit of loosening of that planning process and the controls. And less as it relates to environmental protections, I'm very pro, reducing urban sprawl in that sense, but like there's so much land. Like if you look at the city of Toronto, every time you drive by a 1-story strip plaza in, a densely populated area, the question is, why is that not a high rise, right? And so part of the issue is it takes 5 years, 7 years, 10 years to make that a high rise. And I understand from an investor's perspective, you really don't know what the market's going to be so far out. So you have to have very deep pockets. You have to have a high risk tolerance. You have to be able to weather the ups and downs. You have to be able to qualify for the financing. And then, of course, you've got to go through all of these processes. So, I think that in order to really materially change the real estate fundamentals of Canada, there will have to be some improvement. And builders have been saying this for years, and I do agree with them on that. There has to be some refinement of that process. There has to be a little bit more flexibility as it relates to, some densification. And I do think that the pandemic will a little bit help with that as well, because it has pushed the work from home, the telecommute, the you don't have to be in 20 minutes from your workplace. And as much as everybody is sort of expecting that to keep coming back, I think there's been some level of that's a permanent shift. Actually, as an interesting side note, CMI has always been, or at least for many, many years, been sort of a decentralized business operation. So we don't have a physical large office. It has been part of our strength, even though people looked at us with side eyes. 5 years ago, we looked really good about 18 months ago because we were well ahead of the curve. And I mean, I think we're a testament to, you can run a growth company, a finance company, without having to have that Bay Street office and pull everybody in there. So as people are able to live in Sudbury, in Timmins, in, 2 hours out of GTA, that will hopefully over time take some pricing pressure out of the few what were core markets in Canada and distribute some of that wealth to what had otherwise been kind of declining areas historically.
Yeah, that's an incredible answer. I mean, you are just a wealth of knowledge. I love it. And I'm so glad we got you on, but that's given me a lot to think about. I think you're totally right on all of that. And that's really interesting. I'm glad you mentioned you guys are set up the way you are, because we just transitioned our agency the same way, and we're going to be growing with that model now, decentralized, and we've got rid of our core office. Yeah. And that's the way I want to scale. So you telling me that it's possible is also nice to hear. I'm sure a lot of other companies that have made that transition will be very happy to hear that you said it's very possible.
Because you can attract staff in any city.
Mm-hmm.
Maybe that right person for you is in Halifax. Maybe that right person for you is in Toronto. Maybe they're in Calgary. Maybe they're in Edmonton. And if your business is successful, well, do you really, if you're signing a 5-year lease, what do you like? Do you sign a lease for 30 spots? Do you sign a lease for 15 spots? What happens when you max out your space? You got to go drop all that money into a new lease. You got to go redo all that, move your operation. Right. There's so much energy and money that goes into all of that. And it's a totally different style of management and working, but I would say our staff, broadly speaking, really value that. And ultimately, as a business who works like that, even if it's not for everyone, you will attract a whole different segment. And there's a lot of people out there who they want to work from home. They like working from home. They're good at it. It works with their lifestyle. There's pros and cons, but I would say that has been a strength of ours since inception. And even now continues to be a differentiator for us, because a lot of even finance companies are planning to go back to the office. But in our case, there is no office to go back to. So people feel comfortable that if we say today it's work from home, it will still be work from home next year.
Yeah, I love that. Honestly, that's fantastic. And I'm sure you guys are going to keep growing. And the next time we chat, you'll have 1,000 people and the model will be working even better.
Well, let's hope. I mean, 1,000 might be a lot, but we're and the truth is, even with headcount, like headcount is something funny, because with business owners, it's like headcount is the new car, right? So like we incidentally happen to be 100 people, but if I could do what I was doing with 50 people, I would be just fine with that, right? So I think there has to be a little bit of caution over, you don't want to hire for the sake of hiring, and you want to be careful, like it's not, that you're hiring the right people, and that as you do hire, one of the biggest things for us has been making sure that the corporate culture is maintained, because that's been one of our strengths too. And if you do a lot of hiring and you get too far out in the limb with people who don't understand that corporate culture, you can actually destroy what was otherwise a successful business.
100%. I think everyone can relate to that. We've gone through that even at a small scale. So I do agree. We're going to have you back on because I love this. I could do a whole other hour on just this direction. So we'll probably invite you back at some point. But listen, I want to respect your time. I know it's been an hour already. I know you have a lot to do. So we'll wrap there for now, and hopefully we'll do a part 2 at some point, and dive a little deeper into that stuff. But thank you so much, Bryan, for coming on. It was great. Where can people connect with you if they want to follow along or learn more about the business?
So we're on all the social platforms, LinkedIn, Facebook, Twitter, of course. People can also check us out online. We're actually just about to launch next month a brand new web presence and platform. We're overhauling all of our current websites. It's a great place to find us. You can go to cmiloans.ca. And you can also, as I said, check us out, Canadian Mortgages Inc. on LinkedIn and Facebook. Our social media teams are quite active.
Awesome. That's fantastic. Well, thank you again so much. Appreciate it.
My pleasure. Great to meet with you.
You too.